Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Elconin, along with Brianna Valesky, and we have Mark Minervini on the line, and he is the author of Trade Like a Stock Market Wizard. Mark, how you doing on this volatile Friday morning?
Yeah, good. I see it's we're going to open down here, and we got more volatility with the weak economic report.
Okay, so tell us about your book, Trade Like a Stock Market Wizard.
Well, that book was I was asked to do that book many years ago, maybe 15, 16 years ago, and I held off on it. And then in 2013, I finally released it. Was working on it for several years. So it's turned out to be a bestseller. We've helped a lot of people with it, and conduct some seminars on the heels of it, and it's been great and fun to educate people now after being in the market for 31 years.
30.
I moved to go ahead.
Did you ever work on the floor, or how did you cut your teeth in the business?
No, I just started trading my own account and did really well, and then people eventually wanted to know how I was doing it, and for many years I wouldn't tell them because I thought I wanted to keep secrets to myself. But then I realized there really aren't secrets. It's more based on discipline, and so that's one of the reasons why we're sharing the knowledge now and trying to help others move to the education side of the business, and got off Wall Street, retired many years ago. So I just was trading for my own account for many, many years, and then became an institutional advisor after that.
All right, and you also conduct a master trader program, a seminar providing education about your trading methodology. So what do you teach? I mean, I know you got the whole book and the whole course and everything. What are some of the basics that you teach people?
Well, it's A to Z, my SEPA strategy. So it's the strategy that I've developed over several decades. It's an A to Z training. We think of the book as the flight manual, and then the seminar being flight school. So we try to create a full curriculum to let people understand exactly how to trade like I trade, and to get big returns at low risk, and sort of have your cake and eat it too. This year is going to be a great event because we're having, of course, David Ryan, who was with William O'Neill, three-time U.S. investing champion. We also have my friend Dan Zanger coming, which you probably know him. He turned $10,000 into $42 million in a few years. And then we have Mark Ritchie also, who came to one of our earlier seminars and has done phenomenal since. He's up 1,000% just in the last 4 or 5 years. So this year is going to be a really great event in October.
Yeah, Dan was actually on earlier this week. So is it the charts that you like to look at? Is it, you use the technical analysis to set up your risk-reward ratios? Do you pay any attention to the fundamentals?
Yeah, well, both. I wouldn't buy a stock just because the fundamentals were good. I still want to see the technical action. So although if the fundamentals aren't there, I might go into a stock based on technical action without apparent fundamentals, like with a biotech or something that's trading on a drug approval or something like that. It might not have earnings in the current quarters. But generally speaking, I want to see the fundamentals, or I'm going to be in touch with the story and know the reason why the stock's doing so well, and I'm going to require that the technicals are lining up.
Do you short stocks?
Yeah, I do short stocks, although I have to say, that's not where I made my money. The market does have an upside bias over time. Shorting is definitely more difficult. It hasn't been really necessary for me. I guess if we were in a really long, prolonged bear market, and maybe I didn't make money, in the prior bull market, I might have to short stocks. But there's been, over my career in 30 years, there's been ample opportunities on the upside during the bull markets to make a lot of money, and then be able to have you sit and wait during the bear markets until the next opportunity takes place. And it takes patience, but if you make a boatload when things are good, then you can sit back when the market's not doing so well and still be in really good shape coming out the other end. But if we were in a big bear market here, I would definitely be looking at the shorts. We actually recommended shorting not too long ago to our members when the Nasdaq came back up to the 200-day and the 50-day there, and then we had that big reversal. So we had a pretty good short opportunity there with the general market, but we have not been shorting individual stocks lately.
So what are you making of this mess in the market today? couple rallies, Wednesday and Thursdays, they pop it right up to the Monday and Thursday high and couldn't quite get filled at 29 even. And now we're right back down at Thursday's low. A lot of volatility off the jobs number here. What do you think?
Well, first of all, this is classic action. There's really nothing strange about the way the market's been acting. This is a really classic correction. Everything's been coming in right on schedule as far as I'm concerned. So I don't see this as being abnormal. In a correction, you're going to have rallies that stayed at the end of the day and have bad closes and surprises to the downside. And it's just the opposite. When the market's in an uptrend, you'll have weak openings and strong closes. Yesterday we had a pretty good close. We were down, after the market and the Dow in particular held that 15,979 area. I thought that was an important support level, and that we should hold that. If we really start to trade through there on big volume, that we're probably looking at the NASDAQ going down or the Dow or both and testing the correction lows. The Russell, of course, has already gone through those lows, so we've got one index that's tested those lows. Now it's a question of, is that enough, or do we have to actually have some of the bigger indexes come down and test those lows? How we handle the news today might be telling of that over the next several days.
All right, so you're not shaking them. I mean, the belief that we're in still a major bull market here. This is just a much needed correction. What would change it? I mean, if we took out the flash crash lows, I mean, what would, I mean, a lot of people are saying the market's turned. We're in a bear market now. Get to cash, raise your cash. It doesn't seem like you're quite convinced of that yet.
Well, I don't care whether you want to call it a bear market or correction. It doesn't really matter to me. We're in a market that has been selling off and is not a good environment to be long stocks. So that's all I really have to know. Mm-hmm. We've got a sell signal. We have a risk model that we got a sell signal on 4 days off the high on 724. So I've been out of the market through I've been out of the market through every bear market since I've been starting to trade. So I've never been caught in a big bear market because I don't argue with the market. When the market rolls over, my stocks break down, I get out, I move aside. But let's put things into perspective here. Major bear markets are generally a result of several conditions or a combination of them. One is an inverted yield curve or Fed tightening. We do not have that right now. As a matter of fact, the 10-year yield is slicing below the 2% mark today. I think that's telling of the direction of interest rates. The other is rising inflation. Now, we're at such low inflation that there's probably only one way for it to go, is up, but we haven't seen that yet. The third would be overvaluation, very high PE ratios in the general market. We're actually, based on interest rates, we're about fairly valued or maybe even just a little undervalued based on interest rates. But, of course, interest rates are subdued now artificially, so that's the big question. And the fourth would be extreme deflation, and that's what the market now is worried about. Yeah, because when you get these weak reports, the question is are we in a Goldilocks situation where it's just right and it's not too much slowness where we're going to go into a recession, but it's going to keep the Fed keeping interest rates down, or are we going to go into a recession and that would create a bear market? Now, with that said, I know I'm going on and on, but with that said, the NASDAQ in 2010 corrected 18% without those conditions, and the NASDAQ corrected in 2011 20%. So we could easily go down and be down 15, 20% on some of the major indexes, and that would be a normal sort of garden variety correction, or if you want to call it a bear market.
Right, and I think coming out of the chat here, Yayo says, why are equities reacting so poorly to rates not being raised? And this has been going on, and you just alluded to that. We got another question here coming out, a new member from the chat, Ritus, and they said, Mark, you mentioned that in your early days you were using leverage, and this person is asking how to apply money management with using leverage. Not many talk about it. They have a capital of a few $1,000s. So what's the best way to use leverage?
Well, I started with a few $1,000s, and I started using leverage. And I turned that few thousand into many millions of dollars using leverage. So I know how to use leverage quite well. The thing is that you're going to treat it just the same if you weren't using leverage. The only difference is that you got to be careful of getting on that leverage and just jumping into the leverage. And I do the same thing with just cash. I never jumped into the market with both feet without having some type of traction first. So I might come into the market with 5% positions, 25% total exposure. If I'm not doing well at that exposure and that position sizing, I don't move to 50 or 75 or 100. I actually move down. I'm gonna pull back my exposure. But if I start doing well and I have a few backlog profits, I might move to 50%, then 75, and all the way up to where you'd be able to start getting, on some margin. But you want to build on the previous profits and let those profits finance your bigger risk and your riskier situations. This is what helps you not only pyramid yourself into a really good market and make big money on the upside, but it also helps you not to get hurt and to start digging into your principal, because that's, of course, then you're digging out of a hole.
Okay, and futures trading, stock trading, do you do both or have a preference for one over the other?
Well, I've been able to get very large returns with stocks, so I never felt necessary to trade futures. When I first started and had very little money, I did trade futures, and I was moderately successful at it. But my passion has always been stocks, and I was been able to do so well at it that I never really needed to get that type of leverage. So I've been a stock trader for 31 years now.
Okay, and just moving on here, just when you're watching the market here, what's the most important thing do you pay attention to? Intraday, I like to follow the S&P futures, the top components in it, the leading stocks for the day. Some people like to tick. If we're looking at your screen, what are your top indicators?
Well, I don't really look at indicators. I'm just looking at the market itself. I'm always watching, of course, the Dow, the Nasdaq, and the NYSE and the Russell, and I'm looking at individual stocks. If individual stocks are plentiful and there's a lot of stocks setting up in a manner that's constructive and are going to start moving to the upside, and I see that happening, well, then that means the market's good. For instance, recently we've had this rally back near the 200-day moving average and the 50-day moving average on the Nasdaq. But if you took a look and picked up, lifted up the hood to the car, looked at the engine, there was only about 34% of stocks above their 200 or 50-day on the Nasdaq. So the majority of the market is in a downtrend, while the index came back up to that 200-day and that 50-day. That's one of the reasons why we were looking at shorting right there just recently, because you can just see that there was participation. So it's really looking at the individual stocks, and that's a more simplistic manner, but I'm looking at them individually on a daily basis and running my own screens over the market and finding out if there's plentiful ideas or not. And I find that I've been really good at timing the market, but I'm not a market timer. I just go with stocks, and it always leads me to being on the right side of the market, pretty close to either when it first turns up or it first turns down in major market moves.
What about options? You dabble in the options market at all?
Well, again, early on I did, like everybody, you want to get rich quick, so you try to find the ways and you use leverage. Options have you have a lot of strikes against you starting right off the hop, and you've got time value, you've got to be dead on your timing. There's big premiums and spreads. So for most, options really should be the last thing that you're looking to do. They're very seductive, and yes, there's a lot of upside. And of course, the saying is you can only lose everything that you risk. To me that doesn't sound like a great deal, but so I know to cap your risk, you can go in with options, and if you wanted to do some hedging or something, they might be good. But I don't trade options myself.
Okay, from DB777, is there any sector which should be doing all right or that you're looking in under the current market conditions?
Well, under the current market conditions, and this is one of the reasons why I'm still, not convinced that the market is really healthy yet, is because you see a lot of defensive groups right now. You see food stocks. You see tobacco stocks and banks and utilities. And when you see that type of leadership, that's a defensive type leadership where the money is rotating. Institutions are moving the money out of the risky areas and moving into the conservative areas. We want to see just the opposite. We want to see that money move into technology companies and things that are faster growth, and that will give an indication that the market's better. So right now, I wouldn't go into any stocks right now. I'm 100% cash. I've been cash for quite some time now since we topped, and I'm waiting patiently for the right opportunity.
All right, and from Rod Hood in the chat here, do you give a preference to the stock that pays a dividend or yield, or are you just interested in the setup and the chart first and foremost?
Well, if you get hung up on dividends, you got to realize, companies that are giving out a bunch of dividends are not plowing the money back into, the operations. And companies that are smaller and mid cap and are more aggressive and in the early stages of their life cycle and are really in the growth stage, the stage that you really want to participate in, because that's when a stock can really make a big move. They're generally not giving out dividends or big dividends. So a small dividend is okay because then that allows institutional funds that will only buy stocks that have a dividend to be able to buy that name. So like a token dividend is what I look for. Maybe if it's paying 0.3% or 0.8%, that's fine because it allows the institutional sponsorship. But big dividends usually mean lower return on the price performance.
All right, and nice move in the gold market today. Little flight to quality here, 2040 long-term bear market in gold futures. Any interest? Do you ever trade gold stocks or the miners?
Well, I had a little moment of fame with gold back in, I think it was '94 or something like that, where I got bullish on gold, and this is a perfect example of the stocks leading me not only to the market moves, but I saw a whole bunch of stocks setting up and was buying these gold stocks as they were all breaking out. And I got bullish on gold just simply because all the gold stocks were taking off and made a gold call, and it went in barons and ended up traveling around the community of Wall Street. And it was, like I said, it was sort of a little moment of fame for me that I called the bottom of the gold market back then. So again, right now, as far as gold, I'm not interested in gold. I know oil is subdued also. A lot of people are trying to bottom fish oil. I'm not convinced that it's time to buy those commodities yet.
Okay, a little bit early to step in, and just the last commodity here, crude oil, long consolidation pattern here. Some of the oil stocks have been holding up fairly well. Any take on the crude oil market?
Well, oil, it is down a lot, and there's a lot of people trying to bottom fish it. We'll probably get some type of reaction rally. The rally hasn't been that big yet, so maybe we can get some type of rally here. But again, it's I try to stay away from the commodity type stocks, and also the commodities. They're volatile, and the underlying stocks are more like cyclical names. I'm looking for growth situations where they're sustainable and you can move through even recessionary times. These companies can do well, and not that I might be buying them at that particular period, but if a company's doing really well while the market's down and you're in a slowdown, that usually sets up the situation to have an explosive up move, because what happens is the market actually holds the stock down, but the company's doing better and better, and they're building up their earnings. The valuation is getting lower and lower relative to their earnings, and then it creates that explosive potential. So that's the kind of situation I'm looking for. I'm not one to trade the commodities. I pretty much stay away from that.
And do you do any intraday trading?
Well, I trade around positions, so I may trade intraday, not because I'm trying to day trade more or less, but because I might take an overweight position and then I get the market or the stock moves up very rapidly, and I want to pair off some of my risks, so I'll trade around positions, take a little off. So it's more based on trading around positions than actually day trading. So I'm not a day trader. I'm more of a swing trader. I generally, my hold time is from weeks to months. If I'm selling quickly, it's usually because I'm at a loss and the stock's not doing well and it's moving against me, or it hasn't done anything and I'm on a time stop and I find something that's more attractive. So that would be the reason why I would sell quickly.
All right. I've been on the line with Mark Minervini, author of Trade Like a Stock Market Wizard, giving us his outlook on the market. Mark, thanks for joining us, and we'll have you on again soon.
That was great meeting with you, Joel. Take care.
All right. Thank you.